3, 2, 1. Mr. Speaker, ladies and gentlemen, during the early 2000s, prior to the dot-com bubble, people were saying the same thing about Microsoft and Cisco, that these technology companies would go to all-time highs and be the next big thing. However, given a lot of the macro and systemic risk that led to the dot-com bubble, these great companies crashed over 70 to 80% within the next 5 years, leading a lot of these investors to completely get absolutely wrecked. We need to understand a core tenet of portfolio management, even for mutual funds who I agree are broadly more conservative with their growth expectations. Mutual funds like Vanguard and Fidelity all around the world is risk management. Risk management is a key in navigating the geopolitical and macro tension and volatility that we're seeing today, and this can systemically affect all of the asset classes, especially the most resilient and strong, like what we're seeing right now with artificial intelligence. Unless you've been living under a rock, continued escalation and tensions with Russia and Ukraine, US and Venezuela, the US-China proxy war, and most obviously recently, the US and Iran with the Strait of Hormuz, has significantly affected AI and global supply chains, specifically in terms of chip manufacturing. The energy crisis with oil hitting over $120 per barrel can significantly affect the cost of production for the raw components, including but not limited to rare earth metals and other semiconductor formulas and components that are needed for TSMC, for these manufacturers. Even their competitor, the bigger one, NVIDIA, can significantly increase the cost of these adjacent components that can put a lot of pressure on that stock and on that expectation, because analysts and investors, whether retail or institutional, are worried about the cost of that being transitioned to the customer given a lot of this uncertainty. A few things on opening opposition. Note that this is going to serve as framing, argumentation, and also embedded response. Number one, this is a policy debate about asset allocation, and I simply think the 24-month window is too long and too uncertain, just like what I raised in my point of information. That is to say, we rather have a flat kind of approach. My friend, my brother in Christ, can you please mute? Bro, hold on. I'm gonna pause my timer. Someone's unmuted. Okay, starting again. I hope I can have those 10 seconds. By being flat, we simply mean investing in other shit within a reasonable window. Investing in things like oil, gold, developing markets, military and energy, even treasury bills, government bonds, and corporate bonds. Or even holding majority of that in cash to be able to capitalize on these market opportunities. Side proposition might say, yeah, bro, we're only investing like 0.5, 1% in TSMC. Guys, we're looking at mutual funds, and that 0.5 or 1% exposure are millions of dollars who we believe the opportunity cost, even if a minority position, is too significant given the risk that I talked about, flipping the thing they talked about a minority position. I'll take the clarification before I move on. Go. Yeah, clarify.
You're wrong because of two reasons. You don't need oil, you need lithography, which is light. Secondly, if you talk about transportation, they're already starting to build foundries in US and Japan with the help of their governments. So transportation costs due to oil are also not that high.
Bro, all this bullshit, whether we're talking about that or what I'm saying, is significantly getting more expensive. That is the point. There is specific risk to TSMC. There's even more risk globally affecting all of these particular things. And we think that all of those things still literally have to be passed on through trucks, have to be passed on through boats and planes, which guess what? Use oil. That is why strategically taking long and short hedged positions with oil contracts or even gold is a smarter and better way to be able to do it rather than getting specific exposure there. Number two, let's talk about the inherent or specific idiosyncratic risk for TSMC. China's been quite silent and sneaky amidst all of this conflict. All of the eyes are on the United States, and China is continuing to forward their agenda in Hong Kong, in the Philippines with the South China Sea, West Philippine Sea conflict, and even in Taiwan. That is to say, if any sketchy things happen within the Taiwan area, the sea, etc., can potentially lead to people freaking out and panicking amidst the backdrop of all of these specific forms of conflict already. It's simply not worth the risk. Number 3, and to be very clear, is AI sexy? Is it here to stay? Absolutely yes. Is TSMC an arguably good company? Yes, maybe. But we think that the AI bubble right now is simply potentially on the verge of popping, like what we've already seen with TSMC, Nvidia, Magnificent 7, and a lot of stocks significantly crashing from their highs. It's arguably overpriced already, and the increased production can significantly affect the growth expectations for these companies. Their main competitor, Nvidia, with their CEO, Jensen Huang, already talked about the oversupply. They're also worried about the cost of energy and water significantly increasing given a lot of this conflict, which can put a back on these hyperscalers and these semiconductors trying to be able to manufacture even more. Ladies and gentlemen, side opening government is correct in terms of the broad stroke of things, but they miss the market timing and fundamental valuation in terms of putting this in perspective of an investment decision. We think that raising cash can ironically allow you to be able to buy Nvidia cheaper because it literally might crash 20, 30, 50%. We don't want it to crash. We don't know if it will crash. No one wants this, but we need to be able to err on the side of caution and be able to tactically raise cash and funds to be able to buy the dip or tactically reallocate specifically to other kinds of adjacent industries like what I already mentioned to be able to hedge those risks. Ladies and gentlemen, we think that the core tenet is risk management, and if you want to be able to help these individual investors who put their pension and hard-earned money on the line, even if you're conservative, this is the way to go. We are very proud to stand on side opposition.